Hello everyone, welcome back to another episode of the Revamped Founder. In this episode, we have Carmen Alfonso Rico joining us. She's the co-founder and general partner of Cocoa VC, which is a new age VC fund designed to function like an angel investor. Carmen has had an impeccable VC career from being a partner at Blossom Capital to now starting Cocoa. In this episode, we touched upon the economics of a VC fund. What should founders expect from VCs? What do VCs expect from founders? What happens after a company raises money? What is a term sheet? What are investor updates? And so much more. I hope you enjoy this episode. This is an incredible one. Do listen to it till the very end. Hey Carmen, how are you? I hope you're doing well.
I'm fine, thank you.
First, I want to know a little bit about Cocoa. So, what are you guys doing at Cocoa which is different from other VC funds?
It's a very good question. We actually say we're not VCs. We actually say we were VCs and now we invest like angels. We are a fund, though, to your point. So I guess that is the core difference is that I was a VC for a long time. I was a junior and then a partner in a few VC funds. And at the same time, I was angel investing. And from looking at the market from these two perspectives, I actually realized that there was a gap in the market to support founders as a VC, but from a position of an angel. And so that is the fundamental idea. We invest like angel checks, or VC checks, or angel checks, 250 to 500K checks, no friction allocation. And we don't compete, we collaborate. Now we come in as small like an angel, so that we can be neutral, independent, agnostic. But to that angel check and angel stake, we bring our VC expertise and our network because we've been VCs for a long time, and so become the in-house VC for the founder. So from a value proposition, I guess is that we can help founders hack the system because we occupy the position of an angel, but not all the tricks of VC. From a fund model perspective, to your point on what we're doing different, what is fundamentally different is that in order to be able to play that role with the founder, in order to be able to be very small in the cap table, we have a model that instead of optimizing for a stake, which is percentage in a cap table, which is what a lot of the VCs optimize for, we optimize for access. It's like, I don't care what percentage, I just want to work with these founders. And for that also, we need to be very small because in order to make the economics of a fund work, not really caring about how much percentage of a company you own, you need to have a very small size. So that is the fundamental different idea behind Cocoa is because our size is very small, we can invest like angels, but we bring the all expertise of our VC and become the in-house VC for the founder.
Yeah, that was an incredible explanation. So you guys have smaller stakes in companies. So I think your fund size was $17 million.
Exactly.
Do you guys make money off of management fees too?
No, that's the thing. But it's not necessarily linked to LPs having returns. And I'll explain a little bit about the fund economics and how a fund works if you want. So when you think about a fund and you think, and this is what separates funds from physical angels, from like people investing their money. Let's start with physical people. If I am like a physical person and I invest a check into a company, generally, and this changes depending on how sophisticated the investor is, but generally, I'm going to imagine I invest 10K at like 1 million valuation, and then I exit at 10 million valuation, and the company hasn't raised any more money. So I will get 100K, which means I've done 10x my money. So what I look at is how many times have I made the money that I invest? As a fund, I of course look at how many times I've made the money that I invest, but my goal is not so limited to how many times I've made the money that I've invested. My goal is to have a fund returner. And I'll explain what a fund returner means. A fund returner is if I am 100 million fund, I make 100 million out of the investment into a specific company. Now, this is when it becomes so important how much of the company you own. Because if I own 10% into a company, that I need a company to exit at $1 billion for me to make 100 million, i.e. for it to be a fund return. If I own 1% at exit, I need a company to be a $10 billion company for me to make 100 million. And guess what's more likely? A company to be 1 billion or 10 billion? Given that is more likely to have a company at 1 billion, and I want to maximize the probabilities, which are already very slim, of a company to be a fund returner, I'm going to make sure I own as much stake as I can. And the bigger the fund, the more important that becomes, because otherwise, the less is the probability that a company will become a fund returner. Now, that's why Cocoa, we kept it small, because if I own 1% at exit, a $1.7 billion company is a fund return. And a $1.7 billion company is a much more likely outcome than a $10 billion. So now that is like when you look at returns, if you just like do this math, when you look at returns, it is much more likely to return many times a small fund than it is to return a big fund. Just because it is, so to return 10 times 17 million than 10 times 1 billion, like the amount of like value that you need to. Now, so then what you do when you think of LPs, what LPs think about is on our return profile, small funds are very attractive. The challenge some LPs have with small funds is that they have a lot of money to deploy. And you can deploy a lot of money on small funds because they won't take a lot of money. And so that is a little bit tension. Now, carry is a bit of a different thing, carry and fees, which means that generally funds operate on the 220%, which means you get 2% of the size of the fund in management fees every year. This is simplifying, but to make it easy to understand. And you get 20% of the returns. Once you've returned the fund 1x and above, you get 20%. Great. The thing you have is that the smaller the fund, the smaller the fees, because 2% of 70 is better than 2% of 100. So to your point, we don't make money in fees. So we make money in carry, as in the 20% of returns. That, though, doesn't impact the returns of the LPs. Like it is not like contradictory, right? Like what impacts the returns of the LPs is the amount of money, in absolute terms, the amount of money they have invested and the times that the fund gets returned, but not the fact that I get carry, because that is across the board on every fund. Now, I feel very comfortable with a model when I think of LP alignment, with a model that means I don't make money in fees, because what I tell LPs is, if I make you money, I make money. If I don't make you any money, I don't make any money. So you better incentivize to build the best funds in the world, because on itself, on the day-to-day, I'm not making any money. So I need to make it work. That's a little bit of like a summary of fund economics.
Oh, that was an incredible explanation. I have two main questions from this. So, if you have a small fund size, like you said, you have a $17 million fund size, and you have to get the same amount of return. So, wouldn't that restrict the fund size to the fund to remain a small fund, and it would not increase over time?
That's on a deal by deal basis. As in, you ideally, as a fund, you want to have 3x plus. But the point is that every company, because the returns operates on a power law, which basically means that there are very few companies that will return the fund. The rest won't return the fund. Now, at the moment of investment, you need to believe that every company that you're investing is a fund returner, because that is already very unlikely to happen. So if at the time of investment, you already know it's not going to happen, you're wasting one chip that has zero probability, right? And so now the returns, like that is on a deal by deal basis, you look for fund returners, but as a fund, you want to return 3x plus. My point earlier was that it is more likely to return 3x plus a small fund than a large fund.
Yep.
But me as an LP, I might have different goals. I can have the goal of, like getting lots of returns at 10x. Well, to return a $1 billion fund 10x times is very difficult, because it means you've created 10 billion of additional value. And you only own that small, let's say you own 10%, which means you have been 100 billion in exits. It's very, very hard. Cocoa, if I return Cocoa 10 times, it means I have made 170 million plus the 17, right? So it means like on top of returning the money, I have been part in like like I have taken like 170 million, which if I own like 1% Alex is like 1.7 billion, right? Like as in, so like the point, 70 million, sorry. The point is it's much easier in terms of the amount of money the value that you need to have created. Now, that is like a key. Now, as an LP, I might have another constraint, which is I want to deploy. If I'm an institution that has to invest $1 billion a year, I can't do it on small funds because I can't deploy $1 billion on 500K checks. That doesn't work. So I'm gonna care less about how many times I get it. I will care, of course, about how many times I get it, but I will definitely care about being able to deploy into funds that can absorb that amount and put it to work. And then the other constraint or the other kind of context thing is like in the past few years, interest rates were negative, right? Even.
Yeah.
So actually, it was really hard to get returns on any financial asset. And so suddenly 2x was amazing because like the rest of the world was like, the rest of the financial asset world was like keeping it negative. Now it's not the same because you can make like 5% on T-bills. So now if a fund is asking me to give them money for 12 up to 14 years with a lot of high risk, I'm going to demand very high returns because with zero risk almost and very, very high liquidity, guess what? I can get 5% on my money. So in order to give the money for 14 years and have high risk, I better get many times that return. And so that I think is going to put some pressure into the venture world because now the stakes are much higher in what we need to return given the other competing financial assets, like what they are returning.
Yeah, so your model is completely different from what we have seen, what we see these days. So are there any funds in the same space in general? They're doing something similar to you?
Many. So there's like a big wave of emerging managers and micro funds. In the US, it's been going on for some time. It is in Europe now. So yeah, there are many. So there's not many with this model of a small fund completely. Not many with the VC turned angel because not many of them were VCs in large funds and then became angels. Like they sometimes were operators. They're like so. That is the difference. But as micro funds, in terms of this theory of the small size that we just explained, yes, there are many coming up.
So why did you decide to become an angel instead of?
I did, as in life, I didn't decide to become an angel. I just found myself an angel and then realized I really liked it. It's serendipity. A business angel, I was a partner in a seed fund. And a business angel who I respect a lot, asked me to help him be a founder. I couldn't invest because that founder was pre-launch. And my fund back then didn't do pre-launch. But I went to meet the founder to help this business angel. And this founder was Johnny from Hopin. And he was struggling to get his pre-seed funded. And I was hooked by it. I absolutely was fascinated by him, loved the product he was building, couldn't invest as a lead, but wanted to help him. And I helped him with the tools that I had, which now looking back, I know were the tools of a VC basically. So I introduced him to every investor he met for the pre-seed. I introduced him to the lead of the seed. I helped him with the deck. I reviewed his term sheet. I helped him build the actual spreadsheet of the cap table, like all these things that for me were total bread and butter. Not that for a founder or not. And by doing that, what I realized was I was building a very unique relationship of trust with him. And what I figured in my mind was that it was because on one side, I was tiny on his cap table. I was insignificant. I was a very, very small part. But on the other one, I knew all the tricks and I knew everybody in the VC world because I was one of them. And so I could help him bridge that gap. And back then, I didn't kind of fully realize the potential of Cocoa, but it was the very start. I did realize, though, that I absolutely loved angel investing and working with founders like that. So I started to do lots of angel investments while I was a partner in a Series A fund. And it was then, as going back to what I said at the beginning, when I actually realized there was this opportunity to become a VC turned angel. And then Cocoa was born.
Yeah, I love the name first of all, Cocoa. It's a, I'll drift here a little bit. So, uh, when you invest in a company, what does the investor look at? I mean, talk about it from a VC point of view. What does the VC look at, and what does a founder look at in the VC? So, what do both of these people look at in each other to take the money or give the money?
It's a very good question. From a VC perspective, it depends on the stage. Like the framework of analysis is very different if you're like a Series B or like a pre-seed. So I'll speak about what I know, which is like pre-seed seed investor, and more specifically about Cocoa, because then everybody has their own kind of like thesis thing that they look more at. At Cocoa, I like to say we back killers with a heart. And that's an expression I came up with to introduce some of our founders and then realize it was like applicable to all of them and sort of made it proprietary of Cocoa. But basically, it's this idea that like at pre-seed seed, if you think about it, when you look at all the factors that you look at when you build conviction, which is the founders, the market they're going after, product they're building, business models, or how they're going to make money. Those are kind of the key things. Then there's like within like go to market, how are they going to go to market? Like how do they hire the team? But like when you look at like those factors at pre-seed seed, the point where you have most information is the founders. Because the rest, who knows? Like the market, sure, but it's yet to be developed many times. And so if you just look at today's market, you might make mistakes. Or you might miss things rather than make mistakes. Then you've got a business model generally doesn't exist because the product generally doesn't exist, right? And so I think that the founders and how they're thinking about it all is the main driver. So to me, founders, key. What do I look for in founders? What is a killer with a heart? A killer with a heart is a founder who is obsessed, absolutely obsessed with the problem that they're solving. And the reason is that starting a company is so hard that it is actually irrational versus like having another job. The odds of succeeding are so little. And the work that goes into it is so insane, that the commitment that goes into it, that it's irrational. So if any, like you need to be irrationally obsessed, I have a like almost nonsense reason to want to do it, right? And I think that if it is a very rational decision, then reason will prevail, and at one point they will quit, right? Like, so that's that. The other one is an ambition that is borderline naive, but not delusion. It's a fine line. To me, and I learned this from Johnny actually at his pre-seed, but I want the founder, and how I look at the line between naive and delusional is so that is through speed of execution and speed of learning. And so the thing here is that I want founders who have insane ambition, powered by the fact that they don't really know all the challenges that lie ahead. So it's almost there's no limit to what they can do. Now, they have the capacity to overcome those challenges, because guess what? The challenges are going to come for sure. And so you need that capacity, that speed of execution, that speed of learning to overcome them when they come. Even if you don't know they're coming, they are coming. And so that ambition that is naive, borderline naive, but not delusional. And then third is clarity of mind and clarity of vision. I think that founders who profoundly understand the market they're going after, the dynamics of that market, the user they're selling into, have a head start. And I think that in the past, maybe the market, there was so much money available that you could buy yourself the time to learn on a market and catch up. I think that now that's much harder. And so how I try to measure that clarity of mind and clarity of vision is through that understanding, is through clarity of mind and clarity of vision. Because to me, if a founder can explain me on a sector I know nothing about, and I'm not technical, you can explain to me the pain point so clearly that I feel it. And you can explain me why your solution is the way to go about it. Of course, I'm going to DD it, every side of it. But if you can explain it to me, it means you really understand it. And that is very important to me. I don't like situations in which like I cannot fully put my finger on the pain point they're solving, on how they're solving it. Like I need to understand. And many times I can't understand some missing background, but then I don't. And then that's where I draw the line on where Cocoa invest. But if I am supposed to be able to understand and I'm not understanding, might be my fault, but I also make sure that it's not the fact that the founder cannot explain it. Because if you cannot explain it, I'm not sure your understanding is totally profound. So I think that that's kind of the three things that I look at. So killer with a heart. Now, killer with a heart, going after a painful pain. And this is a very also like Cocoa thing. I do size the market, bottom up, top down. I did 3 years of banking. You trust me, I do size everything. But I do think that as a pre-seed investor, I don't have enough information today. And I definitely don't have any superpowers to see the future and to understand how the market is going to evolve. And so what I look at, the one thing that I can hold on to is pain points. And it's if you're solving a very painful pain point, a top painful pain point for a large group of people, growing group of people, companies, whatever, then I trust that I have a killer with a heart and I have a very painful pain point, they'll figure something out. It might look completely different, by the way, to what they're building now, but they'll figure something out. So that's basically how like the framework, the investment framework of Cocoa. Everything else, information on the product, information on the business model, information on the go-to-market, all that, what does is give me information on the founders, on how the founders think, on how what the founders know, how the founders learn, how fast. So I use all that to kind of inform how about founders. And now, what should a founder look like for an investor? Look, I think many people say that getting investment from an investor is like getting married. I think it is much more than getting married. I think it's like having a baby. I think that it is much harder to get somebody off your cap table than it is to divorce somebody if they're not kids. And I think it's an incredibly difficult and important decision. How I tell founders to look at it is in kind of two dimensions, the kind of more rational and then the emotional. And so the more, and emotional, by the way, is as important as the rational. It's not by no means a different level. Rationally, I came up with this like round equation. And it's not like I came up with it. It's like more just like a simplified way to explain to founders, not rocket science. But is you look at a round, and this applies, by the way, for the full round and for every single ticket. So is you have on one side of the equation, you've got the money that you get and the value that you get. And that's what you are getting in this round. That needs to exceed, needs to be bigger than what you pay for. And what you pay, what you give away is dilution. So it's the percentage of the business that you give away. And that's the most quantifiable way to get. But you also give away economic and political rights. And you also pay because you add complexity to your business, because now you have more stakeholders to manage, right? And so this money plus value add that you get needs to be in perceived value much more than the part of your company that you give up, the economic and political rights that you give up, and the complexity that you add on. And that is the rational way to look at it. And that, again, goes for the full round, and it goes for each investor. And so as a founder, you should always do the exercise of trying to give one value add to each investor. Like, they can do many things, but just have one that you know they are going to do and that you're sort of going to value or benchmark them against. And then emotionally, and it is a must for all these equations, is the personal fit. You need to invest with somebody you feel you want to call to celebrate the wins, but also when you lose your biggest customer and you are running out of money. And the reason, and this is said by many people, but they're like, as in the fact that you need to call under any circumstances and stuff. But the actual reason behind, and this is kind of more how I think about it, so is that at the end of the day, and this goes back to how hard it is going to be to build a business, but it is to start a company, and by the way, like to get it from 0 to 1, and then like get it to 10 million ARR and to 100 million ARR, like all of it is like, it is brutally hard. And so the only way you're going to manage to have the resilience required for it is if it is also the joy of your life. Like to me, cocoa, and I say cocoa is both the joy of my life and the hardest thing I've ever done. And I wouldn't want it any other way. And it's not incompatible, but it's both. And the reason I can actually do the hardest thing I've ever done is because it's the joy of my life. And having the right investors means you can keep it being the joy of your life. If you don't have the right investors, it can become the nightmare of your life. And the problem you have is that you can't keep up building the hardest thing you've ever done if it is the nightmare of your life, because it just takes too much. And so I think that that's the way to think about it, is on top of many kind of, legal reasons why you should make sure that you have the right people on board. It's also just like to ensure that like you're in the best setup to build like a massive company, basically.
Oh, all right, that's incredible. So according related to this, you back killers with heart, but how much of it is like metaphorically true versus like when crisis strikes, the person will fight it out or something?
I mean, and they hopefully don't kill anybody. So I hope it is metaphorically. When it's the killer, it's a concept of a killer. You use the word fight, and I think fight in a positive and negative connotation, but you're gonna have to fight. And this is the reality, right? Is that I don't want to work with people who don't have a heart. I would think kindness takes you very far, and I think it is very important. But the reality is that to be one of the very few people in the world who can build a multi-billion-dollar company, you also have to be a killer. And a killer doesn't mean a mean person, right? But it means like machine. It means an execution machine. It means that you're relentless, that you're not going to stop. It also means that you can take hard decisions and be ruthless. And not, again, in any of those lose the fact that you're a kind person, and that you have a heart and that you care about others and that you're going to take care of others. But you have to be ruthless. And the reality of this world is that you do have to fight. It's like people are not going to give you things for free in general. You might find some candid soul who gives you something for free, but as a system, and fighting is not necessarily fighting against others. Sometimes it's just fighting like forward, right? Like it's not a zero-sum game. I don't like to see the world as a zero-sum game, but sometimes to create win-win situations, you still need to fight, right? And so that's this idea of the killer. It's not that they can kill somebody, it's that this is a killer person. It's like a relentless, hardworking, not gonna stop, and ruthless, but a heart. He's also a great human being.
Now, related to the what founders look in funds. So does at the pre-seed stage, if the fund size, if the amount that the company is raising is a relatively large amount, then they want more investors who can act like operators or help them in the operations. So, and if the money that they're raising is a smaller amount, then they want people who can give them the money, but not necessarily act like very deep operators in the business. How do you think does that correlate with what you guys are doing?
So I think a couple of things before I speak about cocoa, and I'll challenge you on that. I don't think it's the amount. The driver, I think, is the stage. I think what a founder needs, and of course the stage translates into different amounts, but the driver is not the amount that they're raising, it's the stage they're in. And then the other one is the driver is sometimes the founders, right? Sometimes you've got founders who've done it 5 times, and you've got founders who've never done it. And so what they need, and also character-wise, sometimes you have 2 very technical founders who know nothing about go-to-market. Sometimes you have go-to-markets pro who don't know technical. Like it's a very wide range of options in what founders need and when they need it, which actually ties up well with how I look at all of this, which is like I always say to founders, put me to work. I am at your service, and I work for you. You do not work for me. So you just ask me what you need. Like I'm not going to create additional work. I'm not going to do anything that makes you have to work harder. You run your business, and whatever you need, you come to me and I'll figure it out. But it's a little bit of like, first of all, not being too involved per se. I'm as involved as founders want me to be. I'm as involved as I am helpful to them. Because too involved in certain cases might be unhelpful. It's not what the founders want. And because not every founder at every stage wants the same, I let founders decide what they want and I adapt. I always adapt to what founders need, how founders work. It is like I'm here to serve. They are here to put me to work. So that's that one. And then broader question here, and I think is with this is like, I had actually today, one of our founders, we have monthly calls, and I had like, we're on WhatsApp all the time, but then we have like structured monthly calls, like, and they're asking me about like, building a go-to-market from scratch. And my answer is, I've never built a go-to-market from scratch. So what am I going to tell you? Now, I know who's built marketplaces from scratch, so I'm going to connect you to them. And they're going to do me the favor of speaking to you. And also I know what other companies are doing it at the same time, so I can connect you so you can support each other. But I'm very, very careful to not talk about what I don't know, because the damage I can create is much more than the value I can add. So there are other matters that I know because I've done them myself, right? And then maybe I can share my experience, which also doesn't mean is what they should do, but I can share my experience. But I've never built a go-to-market motion. So what am I doing telling them how to do it if I haven't done it? So my job there is to know who's done it and have built a relationship so that they'll speak to my founders, and to know who's doing it at the same time so I can connect them and they can support each other. And that's the most like less damaging, so to say, way to do it. And that's basically how I don't talk about what I don't know. I don't pretend to know things that I haven't lived through. This is the founder's business. I'm here to help in whatever they can, and I help being from a position of having a lot of awareness of what can I talk about, what I cannot talk about. And then the beauty is that I do have a big network that I connect them to. So I always manage to have them being helped in some way, even if it's not directly with my input, which I'm very happy with because I have no ego, basically. Because the thing that I am really, really, really careful with, and the thing that is protect the founder's time, not waste the founder's time. So every intro I make for a founder needs to be high value adding, because if it is not, it is wasting the founder's time. And the most important asset, most valuable asset a pre-seed company has, up until Series A, but actually much longer after, is the founder's time. And so I will protect with like everything I have the time of the founders, 100%. And I do that against other people. And so either I introduce them to somebody who knows what they're talking about, or I'm wasting everybody's time.
Yeah. That's why you have to get experienced people. Yeah, exactly. That makes a lot of sense. So if you, I think I'll drift you a little bit. I know how your fund works now. I mean, not exactly, but I know have somewhat of an idea of how it works. If you select a company, I'm talking about VC in general. I'm not, in this segment, I'm not talking about Cocoa in general. When a VC fund selects a company to invest in, what happens from there onwards?
So immediately their owners is that then the VC puts a term sheet if it's a lead, and then that's all they can to...
From the term sheet, right? What is a term sheet in the first place? Like, you're explaining to people.
So a term sheet is ideally a one-pager. It can be longer, but ideally a one-pager with the key terms of the agreement. So it's like the VC will think through how big the overall round, how big their ticket, what valuation they're willing to pay, many times therefore what percentage, and then a series of other terms like board meeting, not board meeting, liquid pref, not liquid pref, anti-dilution, which are the key terms of the basis of the agreement. That term sheet is not binding per se. What it means is then it will all get negotiated after. Now, The reality is once you sign a term sheet in this industry, you do not get out of the term sheet. As in, it is really bad form on both sides. It happens. It's not unheard of because it is not legally binding. You cannot sue somebody for that. But like once you sign a term sheet, it is sort of a very big step. Now, the ideal process till you sign the term sheet is that you negotiate together with the investor, because this is not a divorce like in an M&A transaction. This is a marriage, or you're having a baby. So you're setting the basis of working together for the next 10 years. So you want to make sure that it is agreed and everybody feels it's a win-win situation. None of the parties feels that they were ripped off. So you've got the term sheet with the key terms. There's a very good book for everybody who wonders like what some of these terms mean, called Venture Deals, that explains it super easily and also explains the why behind, which is very important because it's to understand why is this important to VCs, right? Like why are they asking for it? And trying to understand what the drivers behind are typically helps a lot to get to kind of win-win situation. So you sign that, engage a lawyer, ideally also before signing, so he reviews the term sheet, and then start working on the legal forms, docs. And they can be two things. It can be a SAFE, which is a convertible note, like it's a debt that will convert into equity down the line, or it can be straight a price equity round. There are pros and cons of different ones, and it depends on many factors. But the key differentiator, probably as the most actual one, is that a SAFE is much shorter in negotiation, because given that they don't become your shareholders yet, they are debt holders. The political and economic rights that you need to decide, especially the political ones, are much smaller because they're not getting to your capital yet. They'll get into the next round and then it will be negotiated then. Whereas it will get, if the investors get onto your capital right away through a price equity round, you need to negotiate a lot of things. So longer time price equity round, but lots of certainty for everybody, versus a SAFE that is like more uncertain because you're holding a debt instrument that then can convert into equity, but it's faster, right? And then once you have them as shareholders, then it's to start working together. I guess the only comment I would add around the legals is that, one, get a really good lawyer. That is so key. And a really good lawyer doesn't necessarily mean an expensive lawyer, though typically good lawyers are not cheap. But it is important to get a lawyer who's done this many times, because it is a different type of framework, going back again to the fact that it's not a divorce, that it's not like a divorce, that it is a marriage, having a baby. Like, it is important that somebody who understands that, and it's not an adversarial negotiation that like it's a series of game on what you get, I lose, and like it's important that they understand that framework. So get a lawyer who's done many of these deals. And then two, talk to the lead investor and have the lead investor managing it with you, founder, because this is like signing the prenup before going on a honeymoon. So there are lots of uncomfortable topics in a relationship that is just beginning, and that is not easy. But if you navigate that together, that reinforces the relationship a lot, right? And so I think that is also very important.
But if you get a VC on board, they have invested in the company, what happened after that now? So you did all the legal stuff, you're all good. What, like, invest with everything on the technical point of view, the investor updates and all those things.
Okay.
What do you do?
Again, I think you need to educate investors so that they work for you, you don't work for them. And that is one of my biggest premise. But generally, good governance would say you've got a board every 2 to 3 months. And that probably at pre-seed sometimes that is too much structure, but it is important. It is important to have that kind of cadence of governance, and it's important to get into that discipline. And very bad things happen when people lose that discipline, as we've all seen in the past few months. And then there's a more regular investor update. What I tell founders here is that the investor update needs to be, of course, investors need to know what's going on. And by the way, they need to know what's going on. One, because they gave you money. So it is their money that you're using. And so that's a basic concept. But also because that way they can help you much better. If I don't know what's going on in a business, it's very hard for me to help. If you get everybody on the same page, they can help you. And also when it comes down to making decisions, because sometimes you need investors for a decision, you all speak the same language. Because people don't know what's going on, it's going to be very hard to get them on board with certain decisions if they have no background. And so it's actually the smart thing to do. But it should also be useful for you. I think like founders spending 4 hours a month trying to figure out what to tell investors without it adding any value for them, it's a horrible waste of time. And so have that investor update that works for you, works for your investors, and that gets everybody on the same page so they're in the best position to help you. What I typically recommend is very simple highlights, lowlights, KPIs, asks. Can have much more detail, but like you should make sure that you have your highlights, your lowlights, key KPIs that you're tracking, and the asks.
Yeah, and so that's two questions in addition to this. So, what is the runway for people who might not know what?
Runway.
Yeah,
Well,
the amount of money that
you divide the amount of money that you have left, divide it by how much you're burning every year, every month, and then you know how many months you have left. Now, the interesting thing about this is you can trick it. Of course, anything that is a product of a month, like you take the money that you have in the bank divided by how much you're spending. It's tricky because you can trick it. My recommendation to founders always is do not take the net burns or do not take the revenue minus what your cost is, take your costs. So X revenue, if revenue were going to zero, knowing your cost base and knowing how much money you have in the bank, how many months would you have? Because if you rely on revenue that is not yet like confirmed, you might find yourself with much shorter runway than you want. And it's key when you raise, in my view, to at least have 18 months of runway, because that means 12 months to build plus 6 months to buffer to raise. Because you want to raise when you have 1 month left of cash. Ideally 24, so minimum 18, ideally 24. Anything above 30 starts to be tricky because then you're raising a lot of money. And if you want to keep the dilution general, like as in benchmark, like market standard, that means a high valuation. And guess what? You can have 100 months of runway, but in 30 months, you haven't figured out something people want to use or want to pay for. You have bigger problems than how much money you have in the bank. So is this balance between raising the money the business needs plus a buffer, but not raising so much that at a normal dilution, you get such a high valuation that puts a lot of pressure in the business. That balance.
Practically speaking, what does an investor update look like? The monthly investor update that you guys get. What are the top 3 things maybe that you expect from?
Highlights, lowlights, KPIs, asks.
Awesome. So I think we'll drift a little bit and we'll take our talk after that. So what you give the founder gives the investor base. I mean, I'm optimistic and everything goes perfectly as planned. So what happens on the investor / the fund or the VC perspective post the fundraiser? After you're given the money, what happens after that?
So we all get to work.
At your end.
We all get to work together. So we set up like regular catch-ups. We have a WhatsApp channel where founders can just like ask us everything. We're 24/7 available for anything they might need. And we just get to work together. Work a lot in building the company. And this goes back to going as much as they need me, I'm there. Always 24/7.
Yeah. That's an interesting thing, but isn't it that you are critically optimistic about founders and then you back people? But not every VC is like that. Not every investor is like that. How do companies or founders deal with people who might not have the same thesis as you guys have?
I think there is look, there are 3 types of investors. There are investors who add value, and that's the best investors. There are investors who subtract value because they create work or which are the worst type of investors. And then in the middle, there are the ones that don't add value but don't back founders. And that's how, as a founder, you should look at the spectrum. And then you just look at that and look at the money that you're getting from each of them, and whether it adds up and it's more than the dilution you're giving up, the economic and political rights, and the complexity.
Got it. I mean, I think we'll take a hard stop there. This was an incredible one. On the whole, it was good. That's it from my side. Anything you'd like to say?
Thank you very much for having me, and all the best.
Awesome.
Bye bye. Bye bye.